I'm Dania Siddiqui. I'm an investment director in the industrials team. I think what's been quite clear in this afternoon's discussion is that the technology is not necessarily the barrier here. Some technology already exists to decarbonize these industries, and there is other progress that needs to still happen. But I think what's quite clear is that there is an investable opportunity, but maybe the pace of investment is not keeping up with the pace of the investable opportunity. And I think that's basically the main question that we want to answer here today, that how do we finance industrial decarbonization? Now, as a DFI, we play a role in taking the first step in doing some of the more difficult things, but it's not necessarily us alone who will be able to solve this problem, because the scale of capital which is required here is quite large. And this is exactly where it's quite important that we work quite closely with investors, with banks, with governments in trying to address this issue of industrial decarbonization. And which is why this panel that we'll have now is going to be quite interesting, because we'll have a mix of investors, platforms, and banks who will be able to address this question on what they are looking to do to finance industrial decarbonization. So let me introduce the panel. Munib Madni, who is the CEO of FastP. It's a blended finance platform launched by Monetary Authority of Singapore. Munib? We also have Toby Campbell, who leads carbon market finance and trading at First Rand. And he has been quite closely involved in implementing some of the work that the Transition Finance Facility at RMB First Rand is doing with us. And then also Tushar Kumar, who's a partner and head of industrial climate solutions at Just Climate. Thank you, everyone, for taking the time. Maybe, Munib, I'll start with you. FastP is a relatively new but ambitious initiative which is bringing together governments, DFIs, investors, and banks. What would be quite good for us to understand is if you talk us how this model works in practice and how it is different from project-by-project financing which has existed in the past.
Sure, thanks. Thanks, BII and Dania, for having us here. Yes, FastP is young. It's in the blended finance initiative space. We're a toddler. But we were also learning to run fast and move fast. If you look at FastP, for those of you who have actually looked at FastP at a glance, it is another blended finance mobilization vehicle. But internally at FastP and at MAS, we see it more than that. The way it came about, the origins of it, the architecture behind it, the outcomes that it aspires to achieve, it lends itself to actually being a market development experiment. And it shouldn't be surprising given the parentage of MAS, and also given the fact that it was originally housed under the Financial Markets Development team. And shout out to Gillian Tan, who just walked in. She's one of the first architects of FastP. Sorry, Gillian. So for us, we're more than just a mobilization vehicle. If I start with just the mobilization vehicle itself, again, credit to the architects of FastP as a mobilization vehicle. They created a unique and elegant architecture. It's unique in the sense that it is $500 million of catalytic capital. So we're not a DFI in that sense. We don't have a balance sheet that can be or needs to be deployed commercially. It is all of it. It has to be junior first loss capital, and that's quite commendable. And as a Singaporean, I'm quite proud of what Singapore government has done in terms of allocating $500 million towards pure catalytic first loss junior capital into funds. The second thing for the model and how it operates is that we have a one-for-one matching. That is how we have esteemed partners such as BII, we have EFA from Australia, we have quite a few other partners who come in as junior catalytic capital partners. And this was because we wanted the vehicles not to just have one catalytic partner, we wanted to have more than one. And you know, safety in numbers, maybe, but also it gives a halo effect when you have a lot more junior capital that is coming in with us. The third element of our model is that if financial additionality is a must. We need to make sure that we are not crowding out the private sector. That is one of the top, and it is a framework that we work on very hard with all our fund managers who we deploy capital with. And last but not least, we need to make sure that the fund managers selected are actually going and delivering on this and delivering on the catalytic capital that we need, that we have deployed. And for that, even in the team, in the crowd here, we've got people like Azmeen and Michael and Matt, who all know that at FastP, it's the catalytic first loss capital that actually drives a lot of the E&S frameworks, the guardrails that we put in. So the model itself is, even though unique, it is a mobilization model. Where it differs and where we think it actually pushes blended finance forward is in this thought process that blended finance is not just a structuring exercise anymore. It's a coordination exercise. And it's a hard coordination exercise. And that's where the platform approach comes in. And what we mean by a platform approach is the platform approach starts with a different starting point. The premise is not how do we go and finance each individual transaction one by one. It starts with, okay, we've got capital. We've got to put together, find an investment strategy with a pipeline. We need to find also governance structures that combine or align with everyone. And only then can we actually put it into a structure where vehicle and fund and projects can be delivered one time at a time. And I think that's where the platform approach is something that is new that we're trying to achieve out of this. I'll finish with, and sorry I'm taking a bit too much time, but I think it is important because it is something quite unique about FastP. Why we think it is different from the project by project approach is in what are the outcomes we expect a platform like FastP should achieve. So first and foremost, it sends a very loud signal, visible signal to the market out there, both commercial and catalytic capital providers, that here is a sector, a theme, a region where you can actually not only find impact, but with blending, you can actually get reasonable commercial returns for the private sector if it is done well by fund managers such as Matt and all, Pentagreen and our other partners. The second thing it does, it helps us allocate capital at scale and targeted. So once everyone has aligned on a mission where that is going, then you know that at least that capital would be deployed by the people who know how to deploy it, and it'll be in a focus area. So the allocation of capital becomes much better. Aligning of different stakeholders, whether it be the catalytic folks, within the catalytic folks, you have the DFIs, MDBs, and also philanthropies. Aligning them once around a mission helps actually recreate and duplicate that later on. And last but not least, it also ensures that the size and scale of our funds are so big that private capital feels comfortable going in. The time, effort that they put into coming into our fund is worth the effort rather than going project by project by project where they will say, this project is too small for us. So I think these are the outcomes that we hope a platform such as FastP will achieve and help decarbonize, especially the industrial transformation that we need. Sorry.
Yeah. No, I mean, I guess the alignment piece, which you say, is probably a big challenge. But I think kudos to you and the fund managers who are bringing the different participants together. Maybe just a question follow on, which is, as you deploy capital through Pentagreen and BlackRock Industrial Transformation Fund, how do you see where are the successes and where momentum is building strongly versus where are potentially the challenges and the scale or pace of transition is not as you expected?
Sure. Let me start with the challenges. I want to finish on the successes. So the challenges, first, still is one of the recurring challenges is aligning of the different players, catalytic especially, because every catalytic capital provider has very different definitions of mobilization, additionality, and impact. Getting them all around a table, agreeing on that becomes a bit of a challenge. And again, some challenge that we, with the BII team now, have done it twice over. So we're getting better at it, I think, and getting everyone together. But it's a challenge that once you do get them on board and do align it, the feeling and the achievement are fantastic. So it's worth the effort. The second challenge is pipeline management. And that starts from even identifying the right fund manager to go and invest for you, because often you get people come up and say, there's a fantastic thematic or a sector, but there's no fund manager who can actually deliver on that pipeline. So the pipeline origination, especially for a platform like ours, where we rely on third-party fund managers to go and do the pipeline origination. I think the pipeline management origination does become very important from the setting up of a vehicle, the thematic, to actually identifying the fund manager. Once the fund manager has been identified, making sure that they stay within that pipeline, because pipeline creep happens a lot. People start with one sort of investment laneway and the pipeline proposed. By the time they start deploying it, the pipeline starts moving into different areas. So again, message from Matt and all our other fund managers, we're keeping a very close eye on the investment laneways that we're keeping them in. So the pipeline creep is a challenge. And then I think the third one is just the narrative around blended finance. How do you get the private sector in? Generally, blended finance has come from the DFI sector. I'm an ex-fund manager from the private sector. So I think the fund managers can do a very good job of selling the commerciality of the fund rather than focusing all on the development side, which then scares away a lot of the fund managers, a lot of the investors. We were in Australia doing a roadshow, and the minute you bring out a word like marginally bankable, you find that all the pension funds run for the door because fiduciary duty does not allow them to touch anything. So I think that's a challenge, the narrative, and how to change that narrative away from development to that side. On the successes side, I'll start with the platform itself. For us, obviously, the thesis is platform platform should help raise capital and deploy capital faster and at scale. Right. So far, in the last 12 months, we've had one close with Pentagreen up to 800 million. Tomorrow, we'll be announcing another first close, and hopefully in the next couple of months up to New York Climate Week, we will have a third close. So all our funds will have their first close. In one case, two close. Put aside the funds close. If you look at the partners that have come on board, both from the catalytic side, the commercial side, they're credible, fantastic partners to have. So I think the platform is a success that we're finding. The second one is innovation. Without innovation, especially even financing projects on the ground, if our fund managers do not find innovative ways of providing flexible capital, they're crowding out the private sector. Again, a no-no from our perspective. So if innovation starts not only from the projects that they're actually supporting, but the financing of those projects have to be innovative. And then the fund structures that we are creating have to be innovative to make sure that you get the catalytic commercial folks aligned, agreeing on the one mission, but also various governance standards, reporting metrics, all the rest. So there's a lot of innovation required. And so that's another success. And so that's where the two successes I'll stick with for now. Give me another year, maybe I can find another one for you.
Great, that's great. I think maybe then coming to, from a bank's perspective, Toby, FirstRand is the first African bank to develop a transition finance framework. How has this changed your bank's approach in assessing credit for companies that are not green today, but are on a transition pathway?
Sure. So happy to dig into that. To sort of set some context, and you'll see in the report. So FirstRand has a net zero for its own operations in South Africa, so target, and then it also has a 2050 target of zero emissions from financed emissions. So if you look at how the transition is incorporated, it's very central to the FirstRand strategy, for finance, for investment. And when discussions were happening, in recent years about how is it that we support companies on that transition pathway, it was not possible to kind of the labeling didn't really exist. So in terms of how we were going to allocate certain pots of capital to certain companies, the allocation of green existed. We could place that. But in terms of allocating to the more hard to abate sectors, it was much trickier to be able to work out how we could label, how we could place it, and therefore it was kind of all being lumped together in how we funded normally. And what we've now seen is that because of the work that's been done in terms of developing the transition finance framework with BII, then we have been able to build out, we have the framework which is aligned with the ICMA and LMA principles, which has the second party approval from Moody's. and it's the first one that has been approved in line with the ICMA and LMA principles. What we've been able to do within that is go into sort of detail behind each of the different sectors that are covered, so whether it's cement, glass, pulp and paper, chemicals, aluminium, iron and steel, heavy duty, trucking, shipping, and aviation, and look at those, and there are specific ways that we can look at types of project, types of decarbonisation projects that could be incorporated within that sort of, that can sort of be labelled and therefore can be allocated certain pots of capital, which may be more catalytic, more concessionary as well. So what we've seen as a consequence of that is a lot of excitement, both internally and externally. And one of the things I can say is if you look in the report at the back, you won't find my name there. You'll find Seppo Nsane's name there and Lonwabo Muguduso's name there. And Seppo actually this morning was in a full morning workshop on transition plan, transition strategy with a client in South Africa. So this is happening day by day. And indeed, they've done 4 workshops in West Africa and Southern Africa, not including South Africa, talking to sovereigns, corporates, in terms of how to implement their own transition plans and transition strategies. We're seeing that real shift, and we're seeing that excitement, we're seeing that momentum, and it's early days, exciting times.
And then, Toby, what would you say then, similar to what I asked Munib, around the challenges and then the successes? And I think what would be quite interesting for the audience to understand also is, as you are implementing this particular strategy in emerging market context, how are the clients receiving it, or which sectors or which subsectors are more receptive to adopting or taking on a transition finance facility versus others?
Indeed, so part of the starting point, part of the starting point with the relationship with BII was that, again, just reiterating what Ellen said about 2 entities that have the same kind of ambition and the same mindset, but also our experience in working with clients in those sectors that I just mentioned, and therefore understanding in detail how they operate. So what's been happening is that when we've initially started to engage with companies, there are clearly a lot of them that are at the awareness stage around transition finance, and therefore, what does this mean? Does it mean there's a sort of complete shift, an extreme shift in the operations they need to undertake? What does it mean in terms of reporting, and is it onerous or not? And actually, so there's a lot of education going on, so lots of one-to-one 101s, and so we have been trying to show that when you come down to the reporting, a lot of companies are already reporting the metrics which are needed to show sort of compliance with the transition framework. So whether it's the amount of carbon emissions on a relative or an absolute basis, whether it's where capex is allocated in terms of how much is potentially allocated to sort of decarbonisation or ESG type products. So a lot of that's already in place, and what's being asked is aligned with that. It's not some sort of whole new set. So that's been encouraging. So we're trying to bring a lot of companies on that journey from awareness to knowledge, and then to competence, where we have the transaction plans in place, which is a key part. So it's difficult to deploy capital in this space because until the transition plans are in place, because we have to meet the environmental and social responsibility assessment. We have to meet the does no harm assessment. Then we have to show that the entity has that transition strategy or plan in place, as we discussed. So that's where we're trying to get people to, is get that in place, and then we move on to mastery. So that's the bit that we're looking forward to.
And then there's subsectors which you would think are low-hanging fruit, potentially where you can deploy first.
Yes. If I look at 2 examples today, so one is where we are working on an OCGT, which is converting to a CCGT, so open cycle gas turbine to combined cycle gas turbine, or an example of a refinery where there's work being done to convert it into a hybrid refinery. So in addition to being able to produce petroleum products and refined products from typical crude, you can also change the feedstock so that out the other side we can have biofuels. So it's those are sort of 2 live examples right now, where we can see the low-hanging fruit in the energy sector, potentially in the refining sector, and chemicals and elsewhere.
Great, thanks. Moving on to then Tushar. You are doing some of the difficult first of kind investments, and you are taking early commercial risk as well on some of these assets. So how are you structuring transactions to mitigate this execution, technology risk, to then ensure that you develop something which then attracts capital at scale?
Yeah. So you've heard a little bit about Just Climate and some of the stuff that we've been doing from my colleague Sean and then Natalia. So I'll probably then use that context and background to get into some more of the specifics and a bit more of the detail. In terms of structuring, look, that is key for many of the first-of-a-kind projects that we look at. Many of these are, by definition, a place on the risk profile where our investors expect us to make sure that we mitigate some of those risks through structuring and valuation and other means. All our investors are commercial investors. We do not have any DFI money as of today in our fund. So it's quite an interesting situation where the funds that we have is all largely pension fund endowments, and then the assets where we are investing is risk assets in some ways where we are looking for hard to abate sectors, highest emitting sectors. So that means that we have to be very creative and forward-leaning, and in many cases, actually, a lot of this is about intent and ability to lead. So that's the starting point where we go into many of these situations where we will work with other people. We are growth investors, so by definition, we almost always work with other people. But we typically end up spending a lot of time structuring these deals. What does that mean in practice? I'll give you a few examples, best to work through a few of these. So in our green cement example, right? The project was interesting. There was a commercial arrangement already in place. But what the key risk we were trying to address was a little bit of a scale-up risk. So the technology was largely de-risked, and again, largely is the operative word. It's not fully de-risked. It is largely de-risked. The commercial in that case was actually quite decent. So we really wanted some sort of third-party validation. Of course, you can do all sorts of diligence, but if you spend enough time with the consultant, they will write in a report saying, and no offense to consultants, but most of these things, with given time and money, they actually work, right? But the question for us as investors is how much time and how much money. And therefore, in that particular situation, we said that we will not invest in this till we find a strategic who will actually help us make sure that the technology is de-risked and can be adopted. And that strategic was a customer as well. Now, normally as an investor, you could leave it at that and say, go company, go find a strategic and come talk to us when you do. But actually, we worked with that company to go talk to strategics, found an investor, got somebody to invest. And then together with that, actually structured that round in the right valuation, right structure, and got them a seat on the board with some rights. So that's how we tried and solved that situation. You've heard about Stegra, where there was a lot of structuring involved in terms of different places. But again, the leadership in terms of just leading the board really helps. We have invested in an energy production business in the geothermal space in the US. There, actually, the structuring meant that you actually put money not at the topco, but at the development facility, right? And the way to de-risk was because at the development facility, while there was a huge number of assets to be financed, you could put some money in because there was one producing asset with some cash flows. So we put in place a structure where you could start small with effectively a collateral at that level, which could then be rinsed and repeated against every asset that was put in there. So actually borrowing from what many of you see as a reserve-based or asset-based funding models in commodity markets, where we actually used that concept and then brought that into a very different context. So I think these are some of the examples where you can get into a lot of detail, but by definition, it means that you need to bring, if I step back from it, in addition to leadership, you need to make sure that to enable that structuring, you have to have engineering teams on staff. So we have our own engineers and staff. We have project finance. So while as an investment fund, we have somebody who's worked in project finance in a bank for a really long time. And of course, we have investment professionals. So you bring all of those two together, all of those skills together. And then, of course, there's all the usual tools of trying to mitigate risk.
And then what would you say as you started investing in these projects, what has been the challenges, or let's say what has been some of the surprises that came up as you invested in these opportunities? And if you were to relook at them, what might you change to address some of those challenges?
No surprise, we got everything perfectly right. I wish that was the case, but no, plenty of surprises, of course. Look, I think if I look at the last few years in terms of how we think the challenges have evolved, execution is always very challenging. So you can do all sorts of diligence. You can make sure that you look at the technology. You can look at all sorts of commercial diligence, talk to customers. Ultimately, management teams have to execute these plans. And in most cases where things haven't gone to plan, I think in that case, it's been an execution challenge. And that can be either technical or commercial or a mix of those, right? The environment, of course, hasn't been kind in the last 2 years for our business. So that does have an impact. But actually, when you look at this, execution is the one thing that we all need to get better at, both as teams, but also as investors who identify the right teams who can execute well. So I think that's been one learning. And of course, as if you invest in for us, most of our businesses in developed markets, we do invest in emerging markets as well. But different people and different markets have different skill sets, right? And so when you look at these, we actually need a deeper talent pool. So that's that what we found was quite interesting. I think you were right, completely right, and agree with that framing. That actually most of the time it's not technology. Actually, the commercial elements are equally challenging, if not more challenging. For our hard-to-abate sectors and investments, we are reliant on customers. Somebody needs to pay the green premium. In many cases, if you're not, then fine, we can look at these offtakes. But that can change quite quickly with the environment. So, and therefore, we have to be a lot smarter at making sure that if the depth of and the strength of the offtake needs to really tie in with the green premium. So for some of our investments, we don't need it's greener and cheaper, in which case we actually are willing to take the risk and without any offtakes or contracts. But there are other cases where you need very significant green premium. And in those cases, actually, we have stayed away. In some cases, despite the offtake, we've stayed away, or if there are subsidies, we've stayed away because the premium is so high that actually our judgment is that at some point this will break. So too much of a gap and trying to fill that in through a subsidy or a development capital may actually, it sounds a little bit counterintuitive, but may not actually be the right thing, right? So I don't know what that green premium is, but there are some sectors where we see 100, 200% premium in terms of that's what's required. And our judgment typically in those situations is actually, this is too far away. Whereas if it's 10, 15, 20, 30, 40, 50% premiums, then you look at structures and say, okay, can that work? Right, so those are some of the things that we found challenging in terms of really execution challenges, and then tying up that premium with the offtake and customer willingness to pay. In a nutshell, those are the two biggest things we found.
Right. Maybe just a last question, which I'll ask to everyone, but maybe Tushar, just starting from you, because you mentioned that you invest in developed markets and then you also invest in emerging markets. If we were to reconvene in 3 to 5 years, what would have changed which would enable these investments to be deployed at scale in emerging markets context?
Yeah. So I think the blended finance, and I'm not saying that because I'm in this room, but I think that does have a role to play here. And I think there are different categories of investments. There's a catalytic, there's concessional, and we really need to differentiate, in my view, in terms of this capital by the risk you're taking. So there are some elements where if you are investing in hard-to-abate sectors, right, that is a very different quantum of risk versus, let's say, investing in renewables, which is de-risked, but then you still need a lot of scaling up. So there you need quantity. You don't reach a very high-risk capital. There is still some risk in EM if you're investing in renewables, but it's a different kind of risk. If you are investing in a steel plant, which is green in an emerging market, that's a very different category of risk, and that needs a very different kind and a much deeper blended finance support. So when I'm looking at, like, let's say 5 years, I think all of the de-risk sectors, mostly renewables, BESS, and some mobility sectors, where things are further along the maturity curve, I think they still continue to need a lot of capital, but that's a scaling up capital. So it's a different kind of risk profile. It's a quantum issue in my view, and that needs to happen. But I think there is a second need for a different bucket, which takes more risk, deeper risk, underwrites first loss, maybe return enhancement, and actually brings that to the table so that people, it's not a sequential decarbonization from a, hey, here we do this in a developed market which can afford to pay a green premium, then we go and take the same technology to NEM, right? You need to shorten that time frame. And I'm hoping that with blended finance, actually, you can do both quite quickly in the coming years.
Right. And Munib, what would you say needs to happen?
Is this wish list or is this
It can
what
be
do
a
you think
wish
will
list.
actually happen?
It can be a wish list, and you can tell us the
the wish list
probability.
would be that there's enough financing going around that we do not, from private capital, that you don't need a fast speed, right? That would be the wish list. For that, you definitely need the rating agency. As much as I be careful when I bring rating agencies into the conversation. If rating agencies could actually have a better idea of giving the ratings on, let's say, ASEAN, we're based in emerging Asia transition investment risks, right? And if they can do that credit rating better, maybe that would be beneficial to the private investors. At the same time, capital regulators, if they were to require certain understand truly what capital needs to be protected when investing in these, let's say, transition investments, and allow for more capital to flow from the global north to the south, that would help us well in removing or reducing the need for blended finance. But given the fact that, as Tushar said, blended finance will be a tool that will be used for a while, right? It will be there needed for transition finance. For blended finance to really scale up, other than saying that platforms will work, I think there was a message here about how do you bring in catalytic capital that is new to the space, right? How do you bring them into the blended finance? That is going to be the game changer, because at least the learnings that we've had is that the price of concessionality from catalytic or concessional capital is still very arbitrarily decided. Every institution has their own methodology. I'm not saying each one is, but there's no commonality, at least in all the partners we've found, and what is the price of concessionality for the catalytic capital. If you had more of that, then maybe there'll be easier flow of catalytic capital that will then help price it in. So hopefully we can play a part in that. FastSpeed can play a part in showing what are the price of concessionality in our different vehicles. And what I mean by that is what price someone is willing to pay to get a certain level of mobilization, quality of mobilization, additionality, is it fund level, is it project level, and also impact. So those are the things that would help, in my view.
And Toby, what would you say?
Well, sort of not to repeat what's already been said, but I guess the one piece that we are working on that we'd like to see more of is that moving up the curve for individual companies from that awareness to knowledge to competence, because that's underpinning their ability to access transition loans, transition-linked loans. And so that's where I think a lot of the effort in these days needs to go in order to get people ready for then being able to access those pools of capital.
Mirko from Impact Fund Denmark, the Danish DFI. I really like the metaphor in the beginning of the light switch, so where climate finance is immediate switch and transition finance is more like gradual. I think it's also what makes it challenging, right? Because then it's more difficult to define what is actually going in the right direction and what is not. I think it's also a matter of speed. So is it going towards the switch off, or is it actually slowing down? So, for example, if we think about natural gas, like I'm also interested a little bit. I think it's a debate. It's a negotiation, and then we have some pathways, of course, which are country dependent and temporal dependent. So, is in that case like natural gas? Is it something that we would consider transition finance? Yes. How? What are the thoughts? Yeah. That's a little bit my question, I'm sorry, but I think can be an interesting debate.
You'll get different answers.
Yeah, exactly. I think that so in terms of as a there's lots of debate in terms of gas being used as a transition fuel. My previous hat prior to R&B was at Shell, so that was very much a live topic of discussion. And I suppose one of the examples I would give today, I'm not sure this is a cop-out, but it's just reverting back to that point on But where there is gas already in place, you can find ways to make it more efficient, then absolutely that has to be part of the part of the transition, and so enabling it, because in some cases you can't necessarily move direct, from heavily emitting power sources straight through to renewables, and it may not be the most economically efficient or politically amenable way to go. So.
I mean, maybe I can add to that, right? And look, different people will completely agree. We'll do it differently. For us, in our mandate, we don't invest in fossil fuel, and therefore natural gas is out, and therefore we have backed companies like Meva there, who you heard from earlier, which are actually replacing natural gas in industrial processes. But I do think you need all of it, right? Where there is natural gas locked in, you need to make it more efficient, but at the same time, you can't wait for a 20-year gas field to go through its decline curve and then look for alternatives. I think the time is now, and you can go through that gradual replacement. So you actually need both. I think we are funding one part of it, Toby's funding another part of that, and I think that's the right way to do it.
Thank you for an excellent panel. Michael from BII. We've heard a lot this afternoon about the demand for transition financing from companies, either directly or through financial institutions. Just interested in your thoughts on appetite to supply that transition financing, and I mean from investors. So, I mean, I guess we can think about it as wholesale financing. So LPs into funds, Toby, in terms of lenders to First Rand. What's your sense on how much willingness there is to provide the financing for transition that you then can go and deploy into companies?
Sure. So in terms of, I think I saw a stat recently which people in the room may be able to augment, but around the fact that 2% of current sort of sustainable finance is going into transition finance. So that's a relatively small amount, and that needs to grow. So that's sort of the first thing is to say, we're very early on this journey as transition finance as an instrument related to the other ones which have really grown in the last little while. What we're seeing from an investor or from a lender perspective is we are seeing increased interest. So we are seeing that particularly from DFIs. So we are seeing a number of DFIs who are sort of interested in looking in this space. And there's a lot of people coming up that sort of learning curve to understand, okay, is this sort of part of what we need to include in our portfolio? So we now because there's that harmonization and consistency around the language that's being used, that enables these conversations to happen, and that's enabling that excitement.
On funds, look, it does go through cycles. I think we believe that this is a long-term business, a long-term investment. Therefore, when we went out and raised funds, it's a 15-year fund that we raised. So we could raise $1.5 billion, and we are raising other funds. So there is demand out there in terms of LPs who are willing to invest in climate finance. That's how we call ourselves climate-led investing. But it is a small amount when you look at the overall capital pools that are required to address this sector. There is a lot more that you find in more mature areas which are backing more infra-like or infrastructure-like funds, right? So mostly around renewables or other mature sectors. Where there is a real need is when you are looking at that white space where you're looking for scale-up capital or risk capital. So the higher you go up the risk curve, the lower the availability of capital is, but that's where you need the innovation to move the needle. So I think that's what we are trying to find, that missing middle where actually you are still within people's mandates, fiduciary mandates, where it is a commercial investment from a risk and return perspective, but it is still trying to move the needle. And then that can sometimes feel like threading a needle, but it is expanding. It goes through cycles. There was a bigger pool 4 years ago, perhaps. You've seen a lot of people go through it, but people who dabble in and out. But you'll always find that in any market. But I think there is enough of a cohort there, and with people like yourselves in the room. But that does need to grow, right? It needs to grow by a lot. So hopefully that addresses it.
Thank you to all the panelists. I think today's discussion has been quite insightful. If I can leave you with the 3 takeaways, I think what's quite clear is that transition finance or industrial decarbonization, it won't scale with traditional financing methods. We need partnerships and platforms that bring together various pools of capital, as we are seeing in what is materializing in the market today already. The issue is also not a lack of opportunity. It's around executing these transactions properly. So we need to think about structures that will create winners, that will encourage others to step into this space. And then I think a third real test, which we as DFI feel quite closely and strongly, is in emerging markets, because these markets are going to have to take growth and decarbonizing at the same time. So how do we ensure that both happens? And then one does not necessarily hinder the other. So I think that's a thought for all of us. If we were to reconvene in 3 to 5 years, I would say we would have seen success in transition finance if we are able to make models which we can essentially copy and repeat, right? Which allows these financing structures to be more repeated for everyone. So I think these are our key takeaways, and thank you so much for taking the time for being here. We have refreshments and drinks outside.
Thank you.